Hey there, dividend investors. My name is Derek from the Dividend Talk podcast, and today I will be looking at Spectris PLC. In this video, we'll go through Spectris's business model, its recent financial performance, dividend policy, and investment thesis. See you on the inside. Before I get started, I want to shout out to Darshan on our Facebook group who brought this company to our attention when he asked a question on our podcast if we have ever looked into UK stocks, Granger, or Spectris. It wasn't so easy to find it on the website, but Spectris has a long and fascinating history. It began in 1915 as the Fairey Aviation Company, which was initially manufacturing seaplanes for military and commercial use. Over the decades, this company then has evolved and shifted from aviation into more high-tech precision measurement solutions. This transition has made them a leader in instrumentation and control systems, supplying industries that demand high precision and efficiency. So some of their key acquisitions over the years was in 1999 they bought Servomex, which is an industrial instrument manufacturer, and that plays a key part in the business today. They also acquired Omega Engineering, which strengthened its temperature and pressure business. Fast forward to today, they have purchased over 12 businesses in total since 2018. And this includes companies like MicroStrain, Freeburg Instruments, and Sky Apps. These acquisitions reflect Spectris's commitment to innovation and expansion. They also help the company enhance its technological capabilities and gain a stronger foothold in key markets. So the question is, why so many mergers and acquisitions? Well, like many industrial firms, Spectris has actually faced a lot of challenges in recent years. So they're kind of like a company in transition. They've had declining revenues, they've had supply chain disruptions, and macroeconomic uncertainties, particularly in China, has put pressure on their performance. These mergers and acquisitions open them up into new key markets while targeting high growth areas such as electrification. Spectris operates across three main business segments. Spectris Scientific represents roughly 49% of group sales and comprises of two main subdivisions: Malvern Panalytical and Particle Measuring Systems, otherwise known as PMS. Malvern Panalytical develops automated systems for particle analysis. It is used in industries such as pharmaceuticals, chemicals, and food production. Its tools can help researchers in R&D understand materials at a molecular level, while PMS ensures contamination control in clean rooms. This is a critical factor for semiconductor and pharmaceutical manufacturing plants. Clean rooms must meet a high, strict quality standards, and Spectris provides solutions to maintain compliance in these industries. And lastly, we have Servomex, who technically falls under PMS, but they are reported in their own right. They specialize in gas analysis solutions, and this helps industries monitor air quality and emissions to meet environmental regulations. Spectris Dynamics makes up 37% of group sales, and it really comprises of just one unit, which is HBK. And look, those of you that listen to the podcast will know I'm not even going to attempt to pronounce that name, but I'll highlight it on the screen just so as you can see. But basically what HBK do is they provide integrated virtual and physical testing solutions. As industries adopt more digital tools, this segment will play an increasingly important role in optimizing product performance. So it can provide virtual testing software that enables companies to simulate real-world conditions before manufacturing, which can reduce costs and improve design efficiency. And last but not least, we have other segments, and this category includes smaller business units that cater to more niche industries. These businesses provide specialized services and products that contribute to Spectris's overall revenue, but don't really fit neatly into any of the two primary segments. And material science. So one thing we always look for in a company is their dividend policy. So What does Spectris have? The company targets a sustainable and progressive dividend policy, and their payout ratio is around 30% of earnings and around 39% of free cash flow. So you can see there's plenty of room for growth in that. Between 2019 and 2023, you can see the company has split its cash flow between debt reduction, buybacks, merger and acquisitions, dividends, and R&D. It's actually really well balanced, and I like how they've used the majority of it to pay down debt. They've also bought back nearly 1.5 times the amount that they spent on dividends. So even though they don't mention this in their capital allocation priorities, you can see they have a clear priority in buying back their shares to try and enhance shareholder returns. We always have a running joke on the podcast about sustainable and progressive dividends. Usually when a company turns to sustainable dividends, we always joke that some type of dividend cut is around the corner. But this does not seem to be the case when you look at a company like Spectris. It has over 34 years of increasing its dividends. And you can see that is one nice looking chart. So overall, from a dividend policy and a dividend history, they look really, really strong. So why should you invest in Spectris? Well, the company is well positioned to capitalize on several key industrial megatrends. And this includes automation, electrification, and digital transformation. Because a more digital and automated world will see people demanding even more advanced computing, smart sensors, software, and simulations. So I think it is a decent trend. Their main focuses seem to be in pharmaceutical and life sciences, which is 18% of their sales, technology-led industrials, which is 16%, and electronics and semiconductor. And these three industries alone make up nearly 50% of their overall sales. As I've mentioned earlier, the company have a history of acquisitions. And this kind of demonstrates their disciplined approach to expansion, to enhance their technology capabilities, and to increase their market reach. So there are risks associated to this, and you have to look at the goodwill on the balance sheet, which roughly is about 30% of their assets at the moment. However, with the ongoing macroeconomic stuff going on in China, I think mergers and acquisitions will be really, really important to ensure that they can grow within the countries where those economic difficulties are not present. One positive thing I will say about those acquisitions is that they have very little long-term debt, actually no long-term debt on their balance sheet since 2021. So they have a really, really strong balance sheet. They have strong liquidity, and most of their acquisitions are paid with cash. And finally, the company have demonstrated some strong cash flow generation. As you can see from the screen, their operating cash flow is quite decent. There's a little bit of variability in there. Their capital expenditure is quite low, meaning that their levered free cash flow well supports their dividends. So there's plenty of cash left over for them to pay for that dividend. They also prioritize paying down debt when they need to do so. So they got a really strong balance sheet. They've got really strong free cash flow generation, and they focus on high margin, high growth sectors. And I think this will do them well looking into the future. So what about the weaknesses or risks? Well, it's kind of well known that their delayed implementation of its ERP system had impacted not only its operational efficiency, but it led to lost sales and reduced profitability. But they talked about this in the Q3 trading update, and they're hoping that the second half of this year, it will start to catch back up on these sales. Now, the feeling I got from the CEO is that it hasn't quite yet, but there's still another quarter to go. So let's see. We can also see weak demand in some of their core markets, such as electric vehicles, which we know are under pressure worldwide, particularly from China. Pharmaceuticals were under pressure last year, and even academia. So this has contributed to a 13% year-over-year decline in quarterly sales. Not only that, we can see that there has been a trend of decline in sales since 2019, but it looks like that trend might be starting to stabilize since 2022. So let's see how that plays out. So that's it on our quick take on Spectris as a dividend growth company. I think it's clear that the company is in transition. While it does have a strong balance sheet and they are implementing these cost-saving measures, which can inspire confidence in some investors that there are some revenue challenges and restructuring risks that must be watched closely. So I think it's really important to watch out for this over the next few quarters, just to see if this declining trend has actually stabilized or if there's more economic pressures on the company. But I'm curious to hear from you. What is your take on Spectris? Let me know in the comments below, and don't forget to hit the like button and subscribe. See you next time.